Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Lynn & Associates with your agriculture update for this afternoon of Tuesday, and this is the 14th of March 2017. This is your agriculture update, and the event that's moving ag today is the weather. New York didn't get hit as bad as they thought, but Chicago got annihilated in different areas. Depends where you're at because we have what we call lake showers. But as it moved across, blizzard conditions were in much of the East Coast. 6,000 flights or so canceled today. God knows how many people are going to be screwed up for a couple of days. It impacted the meat markets, which had wild action in them. And the grains were actually pretty stable. As you look at them, wheat unchanged, corn up a penny. The big one down was the soybean market, down about 6 1/4 cents, and then meal down 3.7. But let's take a look and understand what's going on. In the soybean market, you've gone on a weekly charts from 1080 made in January down to 983. Let's call it almost a dollar break in soybeans. And this was a market that had the farmers really in a profit zone up here. They've given back a chunk of that if they haven't done some hedging in it. This was the bright spot of the ag complex. Now I can take this red line and just extend it now down to 990. 9 1/4 because that is where the market finished today. So on a closing basis on a daily chart, from the beginning of March, which happened to have been the peak of the market at 1052 1/4, not this peak back in February, but the most recent one, you've given back roughly 52.5 cents. Okay, not that terrible. When we take a look at the chart, and I've just extended it so you can see it in big numbers here, but I'll contract it in a minute here. Lower highs, lower lows, bear trend until you take out 10, 10 1/4. Now today's action was important because you had a bounce in the market on Monday and you went right on through that. In addition, you had a bearish crossover right here. Here's the market last Thursday. Here we finished the week, and as you can see, the 18-day average in red at 1035 is still above the 100-day at 1034. Okay, and I'm talking fractions there. Then you got under that yesterday, but you hadn't yet made a new low. You have to make a new low if the bearish crossover is going to work, or a new low on the move, not necessarily a contract low, and bang, you get to it. So now the market's number is 10, 10 1/4. You take that out, and you lose the bear pattern. Do you see how that's going? The market also got down to the lower Bollinger Band. Now let's understand what these black dashed lines are. They're an algorithm designed to keep the market trading within them 95% of the time. Yes, you can get above them. Yes, you can get below them, but those are where the market gets to extremes. 95% of the time it's going to trade within them. So there's also tools that I use, and when we look at crude oil down the road, you'll get a feel for what I'm talking about. But when you look at this, you got under the band, and then by the end of the day, you came back, and that band bottom is 997 3/4, 998, and you managed to close over it. So now it's just riding that band down, and you now have 3 days in a row where the K and the D line are under 20. So that's called conversion of an oversold condition to a locked-in bear trend. When the K line, which is the red line, closes over 20, that often signals that prices want to return to the nearest key moving average. We'll call that the 18-day because it's the closest. That would be 1028. Doesn't mean it has to happen, but that would be one of the things I'd look for. So right now, who's in control of the market? Every which way you look at it, the bears. Lower highs, lower lows, swing line. You're under the 18-day average, that's bearish, and momentum is locked into a bear pattern. When you come to the May soy oil meal, it bounced from the lower Bollinger Band. It had been riding it 4 days already. Got its bounce yesterday. Today comes up, makes the higher high than yesterday, and bang, by the end of the day, let's go. And it too has the embedded reading. Now, in this market, what I'd look at is to not take out today's high because that could be what's called a bear trap. When you have what's called an outside day, which is a day that takes out the previous day's high and low, and it's a down day because it closed lower on the day, if you take out that day's high within 2 trading sessions, I view that as a trap for the bears. Bears because it was an outside day down, and that often leads to a challenge of the 18-day average of closes. If that were to occur, the odds are very strong you'd lose the embedded reading as well. It hasn't occurred, so who's in control of the market? The bears, and until they lose that control, forget it. So I give you the warning signs, but it's not how the trend is. Soybean oil has been in a downtrend, lower highs, lower lows. It's now oversold. It finally hit its lower Bollinger Band, hadn't hit it since February, so it's been about 3 weeks. Could be that this market, too, is now ripe for maybe a small bounce in it. In the corn market, we've had what I like to call a vertical price drop because you've gone from a market of 383 right down to the 360 level, straight down. And in the process, you never did set up a trend because you had a higher high and a lower low, and it's still that way. I don't see anything to do off of that. I see an oversold market that might want to rally back to the 18-day, to the 100-day average, which is the green line, and fight its battle there. Wheat market, Chicago wheat, at the lower Bollinger Band. And if it rallies, I look for the market at 437 3/4 to see its first resistance. Again, the 100-day average, but like corn, no trend. You got a higher high and lower low with a vertical price drop. In the sugar, suddenly we're just going sideways. Are you noticing that? It's first thing. The embedded reading is still in place. Until the K line, the red, closes over 20, the pros will sell this market short on the rallies. I don't know that they'll sell the breaks, but there's nothing wrong with that. The problem is if you sell the breaks, you're right into the most recent low. Does it offer you much? That'll be the question they have to answer. In the coffee market, you still have the embedded reading. So it's D-Day. If the market's going to respect this, the lows of today should be taken out and there should be immediate follow through to the market. So that's what I'd be looking at as a bear trader in the market to see, do you get that? Do you get it immediately? In the cocoa, you've had the short covering rally that I pointed out to you from down here. You've now gotten to the Bollinger Band and you're overbought. Guess what you should be telling yourself? If one is long, you can be a hero player, but this is where the odds say, what? The market's into key resistance, probably due for a correction. Cotton market, trying to make something of the 18-day average of closes. Momentum slightly down, not pointing sharply lower. The trend is in terms of the swing line down, but because you're over the 18-day average, you don't have the bias down. Everything fights each other. I don't know what to do with that. Cattle market, yesterday hits the 18-day average, and today falls right back towards that, the 18-day average of closes. Yesterday got to the upper Bollinger Band. I'm probably getting twisted here in my head. Got up there, fell back, look for support there, momentum pointing down. If you take out 114.90, you'll end up back in a bear pattern. Lower highs, then lower lows. Watch out, you could make a run for that 113.75 area. As for feeder cattle, they're stronger than the fat cattle because they have the pattern of higher lows, higher highs. They got over the upper Bollinger Band. Now they're riding it with an overbought condition. Again, I think the smart money coming out here, but you got to remember on these meats, what happens is you get these snowstorms and animals don't come to market often in snowstorms. You can't even move in some of the areas where you get 2-3 feet of snow. So the market, if the slaughterhouses want the animals, there's no animals to buy, prices go up, but as soon as they show up on their doorstep, guess what? I don't really need those animals. Of course they're not telling you the truth, but it's how it works. And as you look at the hog market, higher lows, higher highs to the upper Bollinger Band, overbought. I think the smart money came out of it right up here, and they're saying goodbye. I want to talk to you about my market research for a little bit. This is what I call my video. In the morning at 8:30, I try to record and post to give you, with your cup of coffee, that's why I show it, ideas about trading for what's going on. The night before, I write my commentaries and trade recommendations. I back them up in the morning post, and I teach you in that morning post a lot of my concepts. I don't teach them all, but I teach most of them because what happens is I'm trying to reinforce what I teach in my charting course. I want you to be able to do what I do. That doesn't mean everything I do is right, and certainly I don't walk on water. In fact, if anything, with my 45 years of trading, if you could see me, I'm Swiss cheese. I got holes. I've been wrong so often. I've also had good calls in my career. It gets balanced. But here's the thing. I don't make the same mistakes I made back here. And back here, I didn't make the same mistakes I made back here. I can keep going off camera if you understand what I'm getting at. That's what I try to bring to you. Ideas on chart analysis as to why, the who's, the where's. And as you know, not everything's going to work on chart analysis. Otherwise, either I'd be the richest guy in the world or somebody would be, because every time your analysis would be right. The key is, if you're going to take a trade, no risk before you put the trade on. So what I'd like to show you is something of how I do it. If you haven't tried my research, I'd like to give it to you for 20 days. You're going to get access to what I write. Looks just like this with specific buy and sell recommendations. If you want my oral updates that come via phone, I explain things. You're going to get my videos which show it. Just call us. Go to our website. You'll see a carousel of free offers. It's market research. Click right up here if you're watching me on YouTube. You can, when you click that, a whole form will appear. Choose my market research. We'll make sure you get it. Or under us on many websites, you can click there. You'll see what that research does. Just fill out the form. We'll put you on. I'm Ira Epstein. Thanks for watching, and I'll see you all tomorrow.